Welcome to It's a Beachy Thing podcast. I'm Daryl Palmer, your host at the ocean, and I've got with me mortgage expert Dave Ramirez with Movement Mortgage, and we're here to talk about this hot word we're hearing in this COVID times, forbearance. What the heck? I mean, we haven't heard that word for a long time, and most of you probably never heard that word. What does it mean, forbearance? I did a video, Dave, on my website, on my blog. It was for forbearance is not forgiveness, and it was only a minute and a half, but we need more time to unpack this. So, Dave Ramirez, talk to me.
Yes. Well, good morning, Daryl. Thanks for having me on. For those of you that don't know me, I'm Dave Ramirez with Movement Mortgage, Senior Loan Officer. I've been in the mortgage industry since 2004, so over the past 16 years, certainly seen some ups and downs. And, having worked through the Great Recession of 2008, 2010, I thought I'd seen it all, and that was going to be the extremes, right? But here we are, certainly in unprecedented times right now. So the forbearance issue is a really hot topic in the mortgage industry right now. And basically, with today's economic conditions as a result of the coronavirus pandemic, the mortgage industry is really seeing quite a double whammy. And basically, it's a bit of a two-sided coin. And what we're seeing is, two major issues that are impacting the industry right now. Number one, we've got, record unemployment right now. Massive, the weekly jobs loss report is coming in the millions. It's just absolutely unheard of. Right now, we're probably looking at a real effective unemployment rate of probably around 22%, which, is record breaking. We haven't seen anything like that since the Great Depression, nearly 80 years ago. So that in and of itself is very troubling for the mortgage industry. The mortgage industry is predicated on a borrower's ability to repay their mortgage. And, one of the primary ways we demonstrate that is through employment and, of course, income, right? So both of those are being severely threatened right now. We're seeing a lot of compression on employment income as a result of the stay-at-home orders and just general economic conditions, right? So that in and of itself is a pretty major hit to the mortgage industry. On the other side of the coin is forbearance. Forbearance is really interesting because, that's a topic that is always applicable to the industry. It's certainly something that has always existed. However, due to the CARES Act, which was, the financial stimulus package that came out, passed with Congress about a month ago, what they did was effectively authorize all borrowers who have a federally backed mortgage, which is roughly 60% of the mortgage industry, to elect to forbear approximately initially 6 months worth of their payments with a potential of 6-month extension, resulting in a total of 12 months of forbearance. So what's important to note is that, we'll go into forbearance here in a second, or the details, but, both of those two things, the unemployment and the forbearance, are really putting a lot of compression on the mortgage industry right now. And so that being said, forbearance is a really interesting topic because, as you mentioned, Daryl, really good point. The first thing when we talk about forbearance that we want to make sure everybody understands is that forbearance is not forgiveness. This doesn't make your payments go away, permanently. You don't just get to skip those. What forbearance really means in the traditional sense, again, forbearance has always existed for mortgages for the past couple of decades. When you go into forbearance, you're explicitly, attesting to your lender that you are experiencing an economic hardship due to loss of income or loss of employment, right? Now, in the past, you would need to demonstrate that. You would actually have to prove that something had happened, you lost your job, or your income was substantially lower. What's interesting about the CARES Act was that there was no requirement to actually document and prove that you were experiencing this hardship. So all a borrower had to do was simply make an attestation affirming that they were experiencing this hardship. And again, this was legislation that Congress enacted. So all lenders with these federally, servicing these federally backed mortgages had to basically, submit to the borrower's request and approve the forbearance. So here's what's really interesting about forbearance. In a traditional sense, a forbearance works like this. What a borrower does once approved is they get to skip 3 months worth of payments, right? That's kind of the classic situation. After 3 months, on the fourth month, all the previous months are due and payable plus the fourth month mortgage. So they would basically be making 4 monthly payments all at once at the end of that 3-month forbearance period. Now, that is, for somebody who lost their job, I don't really know how they're going to suddenly come up with 4 months worth of payments if they couldn't even make the 1 month payment or the second month payment, or third month payment.
That's just
previously.
so obviously not logical.
It is. It's defective
and frightening.
thinking.
And frightening.
This
is the part that frightens me the most, I think.
Right. And so anyway, so with the forbearance, what's interesting is that with the CARES Act stipulating that a borrower could go 6, potentially 12 months into forbearance, then the question is sort of like, well, gee, at the end of the year, how is that going to work out? I mean, that's a huge amount of a payment to come up with, obviously, years worth of payments. If you had a $4,000 a month payment, which is pretty typical for someone with a $700,000 home, that's 12 times, that's huge.
48,000, almost 50 grand. Yeah.
Yeah, it's almost 50 grand. 12 times 4,000. That's huge. 48 grand.
All at once. Hey, stroke a check for 50K.
Yeah. So
54K plus my next month's payment.
Yeah, right. Yeah,
right?
Exactly. Here's my 13th month payment too with it.
Sheesh.
So anyways, so they did come up with some stipulations about how that would initially be repaid, because obviously that's not realistic. So I'll show you a couple slides and some details on that in a minute here. What is good news, though, is that Fannie Mae just issued a press release yesterday that what they're going to do in response to the forbearance, as opposed to having those payments due and either payable or due and sort of repayable over a multi-month period, right, in addition to the regular payment, is that they're actually going to allow a full deferment, which is another term. What that basically means is whatever that amount due at the end of that, say, 12-month period in this example, let's say it was 12 months of a $4,000 payment, let's call that $48,000, is that you could actually defer that amount to basically the very end of the loan. Now, it doesn't increase the actual loan balance of the original mortgage, and it doesn't recapitalize and calculate a new payment based on that. It simply states that we're going to take that $48,000, and when you sell your home or when you refinance, it has to be paid off. It's almost like a second lien in a sense on the property. Yeah, no interest payment, no interest accruing, no payments due. So that's really good news, and I think that's what a lot of people, when they initially signed up for forbearance, 4 or 6 weeks ago, I think that's how they thought it would work. Luckily, that is the case, so that's good news, right? So here's what's interesting, though, and here's where I think this is a really, really mission-critical topic right now, because what a lot of people don't realize is that, again, when you seek forbearance, you are explicitly stating that you're experiencing an economic hardship, right? Loss of job or income. Now, if you are going to try to refinance your home in 6 months down the road from now, right? When interest rates drop, they're on a nice slow glide path, getting lower.
Right.
Fannie Mae is predicting interest rates below 3% next year. That's going to be an amazing opportunity for homeowners to save a lot of money. Or let's say you were thinking about selling your home next year and buying something new. Here's the catch-22. The Fannie Mae guidelines, as they read today, effectively state that a loan has to be current before you're eligible for new financing. If it is not, if you have late payments, or if you're in forbearance, specifically pursuant to this conversation, that the loan actually has to be brought current, so that amount that forborne amount has to be paid, and here's the big and, it's a 12-month waiting period. So if you were even, let's say, in a 3-month forbearance situation, let's say you got it current 3 months from now, then you're looking at a 12-month waiting period. You're looking at 15, probably 16 months before you're going to be eligible for any kind of new conventional financing. So that is something, the classic law of unintended consequences coming into effect here. And I think that a lot of folks didn't understand how forbearance would impact them, moving forward. And so this is something we're trying to alert anybody that's thinking about listing their home, right? I mean, if you were listing your home today and you went into forbearance a month ago,
right,
and you're thinking, no problem, I'll get a mortgage in 3 months when it sells, you might not, right?
Right.
So pretty serious issue. And here's the real kicker is, I had a conversation with a guy 2 days ago, very well qualified, him and his wife, collective income of, gross income over $250,000 annually. I think they had a pretty modest mortgage, about $500,000 on their home. I can't imagine it's more than $3,000, $3,500 a month. Basically, we were talking about his plans to move up and buy something new in, this summer or fall or something like that. And at the end of the conversation, we probably talked for 30 or 40 minutes. At the end of the conversation, I said, this all sounds great. Let me get you some numbers. We'll talk about next steps. I said, by the way, in case you're thinking about it or in case it comes up, definitely do not apply for forbearance, because if you do, there's going to be you got to bring it current, and it's giving you a 12-month waiting period.
After you bring it current.
After you bring it current. Yeah. Guess what? The line goes silent for about 5 seconds. He says, oh crap, I think I shot myself in the foot. I applied for forbearance a month and a half ago. Oh man. Classic scenario of a borrower that didn't need to apply for forbearance, really didn't need to. He seemed fully capable of making the payments. And here he is, probably did shoot himself in the foot in terms of his ability to either refinance into a better rate or try to move up and buy something down the road.
Darn it. So, God bless the mortgage servicers and the mortgage companies for really making sure everyone understands what's going on. I'm sure that I'm going to say the word idiot on the phone who talked to them, or even if it was an idiot who wrote a letter and that was just had to fill something out online, there was none of that. Or if it was buried in FAQ, like 45 pages long, that in a -10 font. It's just like, you guys are the experts and you guys hold the loan. You guys are making the rules. You need to explain the rules so people know this stuff, and then they're not. And then you and I get to deliver the bad news. That's why. So if you're just joining us, I've got Dave Ramirez with Movement Mortgage on, mortgage expert since '04. So he has been there, done that. And we're talking about the word forbearance, and it has to do with deferring a mortgage payment because of this COVID-19 stuff that we're all dealing with right now. A lot of people have lost their jobs. I know a lot of people who have lost income, and it's scary out there right now. We're just opening things up now. It's currently the middle of May in 2020. The beach opened up this week, and it's going to be a madhouse down here. Everybody in Southern Cal is going to be it's not social distancing. I digress. So the key here is, if you need forbearance, make sure you understand the exit rules, and understand that if you get forbearance for a year, say, and that takes you to, let's just say, May of 2021, and then you start resuming your payments in June, let's just say, of 2021, a year from now.
Yeah.
You would have to wait until June or July of 2022, that's a lot of 20s, till you could apply for a mortgage, get a refi, anything like that. That is a long time to hold your breath. Like right now, that's 2 years from now. If you decide, if you have to do it, you have to do it. I mean, it's better than a foreclosure or a short sale, because that's what we don't want to see, because a lot of people have equity. This was the thing that was so frightening. And thankfully, Fannie and Freddie stepped in and made it a little more sane, because I was just thinking, well, this is a great little ploy for the mortgage companies, the banks go, hey, these people with 50% equity. And this is different than it was back in the last recession, when nobody had any equity and they were buying homes for nothing down and breathing on a mirror like, you're approved for $1 million. Good job.
The good old days.
Yeah, I know that. I know that you just sweep the floor at this one restaurant one day a week, but you're great. You have a $4,000 payment.
Enjoy your $1 million home.
Yeah. So it's not like that, but this was terrifying when these guys all of a sudden are like, oh, well, yeah, we're just going to have to foreclose on you. And these guys can't refinance, or they would have to Maybe you go to hard money, and that's 8-10%. That's terrible. It's just it's mind-boggling at what this mess could have done. And who would have won? The banks. And who do we hate? The banks. I know you work for them, but ever since that last recession, do not trust them. Sorry. All right. So,
well, you brought up a good point, which I think is, we're drilling down on is, the point of this forbearance as part of the CARES Act was really a foreclosure prevention tool, right?
Right. Exactly.
And you're absolutely right. Here's an interesting stat. 60% of all the residential homes in the country, 40% of the residential homes in the country are owned free and clear, which is a pretty staggering number, right?
Yep.
It's a huge amount of people that either people or investors that just flat out don't have a mortgage. Out of the remaining 60%, the average loan to value is about 54%. Americans are sitting on like a record amount of home equity right now.
Mm-hmm.
And I think the one thing, and again, with the passage of the CARES Act, a lot of times Congress, they're not always consulting with everybody, the key player. Did they call FHFA and Fannie Mae and Freddie Mae? No, it's, they're just beating off the lobbyists at the door, right? Everybody's at the feed train. So anyway, a lot of times these things get written rather hastily without consulting, the appropriate parties to really, weigh the pros and cons, right, and consequences. So, again, it was a foreclosure prevention tool. I think that with the modification, well, I don't want to use the word modification, so I don't want people to confuse that with the loan modification.
Yeah, right.
But with the change of terms of the forbearance into a deferment, I think that that's going to protect people. Because you're absolutely right, Daryl. I would be terrified to think of all these people that went into a forbearance scenario. 12 months down the road, it's due and payable. Guess what? They're still unemployed, or now they really are unemployed, and they're going to lose 50% of the equity on their home because it gets foreclosed on.
Right.
Or they're going to be forced to sell, right?
They're forced to sell. They have to move. They can't buy something else, and then they're forced to rent, and it's just a mess.
Yeah.
Just a mess. So this is Fannie Mae and Freddie Mac. What about the jumbo products that are out there and the super jumbos? Where does that play with this Fannie Freddie ruling about deferment?
Yeah, great question. So the CARES Act was explicitly for federally backed mortgages, or basically backed by the agencies,
okay,
which would be Fannie Mae, Freddie Mac.
Sure that. Okay, that's good to know.
Yeah, and then HUD loans. So Ginnie Mae, which is basically provides the financing or funding for VA, Veterans Administration, and then FHA loans. So those are kind of govt loans, as we call them. So those are the ones covered by the CARES Act. Now, if you don't have one of those, if you have a jumbo loan, then they're not obligated to necessarily provide forbearance relief, right? So, but most lenders are more or less adhering to the spirit of the law. And again, there's so many different lenders and investors and mortgage servicers out there. I dare not paint with too broad of a brush here. But from what I understand, the majority of them are in fact honoring, the spirit of the forbearance within the CARES Act. And so, an interesting stat that I've seen is that this was as of about midweek this week. I believe we're closing in on approximately 8% of all U.S. mortgages are in forbearance right now. And to put that into a little bit of perspective, on March 1st of this year, barely 2 months ago, right before it hit the fan, that rate of forbearance was 0.25%, a quarter of 1%. We're up to 8%. That's a factor of 32x.
God, that is just so. I'm going to use the F word again. Frightening.
It's pretty staggering. It's staggering, and it's still
staggering. I wish I
growing.
said staggering. Darn it! I'm going to say it next time. I'm using that word.
There you go. It is. And so, what's interesting though is from what I'm hearing, the tea leaves that I'm reading is that the basically the FHFA, which is the Federal Housing Finance Administration, they're the very top of the pyramid authority that looks over Fannie, Freddie, Ginnie, basically everybody else, right? And my understanding is that Mark Calabria he's intimated that they're going to close the window on forbearance requests probably at the end of this month. And so We haven't heard that officially yet, but I think that that's probably what's going to happen. And so, and then, to circle back on this whole, again, this 12-month waiting period is really the real crusher, in my opinion.
It's ridiculous.
Yeah, it is. And my experience has been that when, the law of unintended consequences is that, as people start to voice their frustration, or, you see some people starting to suffer as a result of this, the housing was really going to lead the economy out of this little mini depression that we're in right now, right?
Right.
I truly believe that.
Oh, of course it will. Yes.
Yeah. And so, if you take 8 to 10% of all those people that are in forbearance, if you take them out of the equation,
out of the market,
financing, or purchasing new money, purchase financing down the road, that's a huge hit. That's a lead pipe to the kneecaps, right?
It's 10% of just here. We're going to tie your hands because we can.
Yeah, and so
it's idiocracy at its finest. Yes.
My thought, and I don't know if this will happen. I haven't seen that. This is just Dave's thoughts, and they're on sale for a penny. Is that the agencies are going to change their tune, and they're going to get rid of that 12-month thing? Because here's the thing, as well, is an important note is that as part of the CARES Act, is that if you are in forbearance, the lender they can't show you as late on your mortgage, on that mortgage count on your credit report, right? In a typical forbearance scenario, non-CARES Act, then yes, you'd show as late, right?
Mm-hmm.
Now what they're doing is you won't show a late payment, so that's good because that won't impact your credit score. However, there's going to be notes attached to that account that say, much like student loans, in forbearance. And that is the scarlet letter that those folks are going to have to wear. So, yeah.
So I'm sure that the big banks probably will go, oh, you had forbearance. Well, then you have to wait another 12 months and then you have to hold your breath and learn German.
Yeah, or Mandarin.
Mandarin. Yeah, gosh. All right. Well, I mean, it's good news, but we do the CARES Act, but we can't make it, work for everybody. We got to put something that'll hurt you. So let's do the 12-month thing. Let's just tie your hands up. Hopefully somebody will, with some ability to use logic, will and have the ability to change something, will get involved with that. Hopefully later, but we won't know until now. Right now it's middle of May in 2020. Beaches just opened. Blah, blah, blah. Hey, so I got some numbers here I wanted to talk about just real quick. This is just COVID stuff, right? So I got my real estate license in 1986. That was I got it in August, and in October of 1986 was Black Friday in Wall Street, where people were jumping out of buildings because they lost so much money because the stock market crashed. That's how I learned how to sell real estate on a market like that. But blah, blah, blah. I've been in a lot of them, right? I've been in all of them since the 86, right? So I quit watching the news then. I quit taking the newspaper. I don't read it. I read the Beach Reporter. That's all the news I need. All the local news, right? Yeah. I don't watch any of them. I don't even have TV. I have like Amazon. That's the TV I watch, right? So I know enough to know enough. And people are like, well, how do you miss out? I'm like, I seem to be doing fine. I got here and it's all right. So for those of you who are like really paying attention to all the news, stop. Don't. Maybe give yourself 5 minutes a day or 5 minutes a week. I swear to you, you won't lose anything and you'll be more calm because you won't be so mad about the president said this and then Dick Cheney shot somebody else in the face and just whatever. Yeah. Here's the thing. Okay, I am not a doctor, even though I play one on TV sometimes, but it's my TV. So still TV, right? COVID numbers are like, they're made to shock, right? LA County's like, oh my God, there's more and more and more. Well, here, think about this. There's more COVID cases being found every day. Why? Because they're testing more people than they were a month ago every day, right? So just math, if you test more people, you're going to find more people who already have it, right? So there's a lot of people who have it that haven't been tested. So don't be surprised when the numbers go up because they just got tested, right? LA County, oh, it's a hot spot in California, blah, 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 right? How many people live in LA County? 10,105,000 people. Of course, it's got a lot of numbers because it's the biggest county in California.
In the country, by a factor of 2.
Yeah. So San Diego County is the next largest county. 3,300,000 people. Then Orange County at 3,000,001 and Riverside at 2,000,004. Nowhere near the number of people that LA County has. So of course the numbers are going to be big in LA County because there's 10,105,000 people.
Yeah.
So if you think about those numbers and that kind of a thing, it's not going to be like so shocking. Like, I think because of nobody's driving on the 405, there have probably been less deaths on the 405 than there normally is in April and May and March from people just not going on the 405. So you can drive from here
to
downtown in 25 minutes now, which what?
Yeah.
That's pretty funny.
You know, and to that point, Daryl, actually, I think what's interesting is, you know, I did read an interesting article was talking about how, you know, all these travel bans through, you know, every country's got like travel ban, right? And so it was an interesting take in this article, basically stating that travel bans are only so effective. And then there's a kind of a point of diminishing returns where when you cut off access to goods and services, that the quality of life actually starts to deteriorate as well. So, and I'm not just talking like, you know, I couldn't, you know, go buy a new TV at Costco today, not that quality of life, but, you know, medicine and, you know, technology or whatever aren't flowing in a way, and, you know, or hospital service, whatever, medical services in a way that they normally would. Or if you're talking about the third world where, you know, we're talking about food and just bare, you know, staples and, you know, just to keep people alive, where, you know, the flow of those goods starts to constrict, and that in and of itself impacts not just quality of life, but, you know, actual life expectancy. So it's interesting.
Yeah, God, there's so many things going on here. Hey, you have some slides you want to show us, right? You got some screen sharing you want to do?
You know, actually, I was just looking at them and we kind of buzzed through everything in here. And so, you know, I think we'll just skip those. If anybody has trouble sleeping later tonight, dial me up. I'll go through my 77-page deck and we will put you
right here. Okay, that's cool. So as far as current real estate market, I'll just talk to you about that real quick. So just in the last week or so, things kind of woke up a little bit, and there has been more homes put in escrow since we shut down in the middle of March. Initially, you know, our dear governor said, oh, real estate, what are they? They're non-essential. And then somebody had to tell him that, I don't know if you knew that, but, you know, real estate industry is about 50% of the economy, dummy. Mm-hmm. So
yeah, directly and indirectly. Yeah, absolutely.
Right. Like when you hire us to sell your house, we hire everybody. We involve all the trades, florists, caterers, appraisers. I mean, it's just like so many people are involved in a real estate transaction that, and even after somebody buys one, then the trades are coming in and just doing stuff. And
I think new homeowners tend to go to places like Home Depot and Target.
Exactly, right? Home goods places. It's just, so anyway, 2 weeks later, they're like, oh, okay, you're essential, after they shut us completely down. And then the LA County supervisors 2 weeks ago, they're like, oh, well, you can't show a house if it's occupied. So that screwed the 90% of sellers. I mean, if you're a seller in this market, you have to sell. And if you're a buyer, you want to buy, you have to buy. There are people and they're doing it, right? So we figured it out. We're doing virtual tours and virtual showings and virtual open houses. And we're doing a lot of stuff on this Zoom platform. God bless Zoom, right? And, you know, we're figuring it out. You know, we can get you in a house and we're gloving up and masking up and putting booties on and nobody touches anything. And we can do it, and it's happening everywhere. So there has been some bubble in the market. When we started this thing, interest rates were at probably their lowest ever, I think, right?
Yeah.
And inventory was super low. So when we started this, we were in a super seller's market, low interest rates, Low inventory, a lot of buying pressure. So there's multiple offers. A lot of people, I'm working with some buyers, they're like, we can't get one. We keep writing offers. I'm like, well, you should call me because I can help you with that.
There you go.
So when we come out of that, we are going to have interest rates not quite as low, but it's going lower when we kind of figure out this mortgage servicing thing and all that.
Yeah.
But low inventory. So it's probably going to be pretty robust when people go, oh, we can go outside, we can do things, oh, we figured out how to do the real estate. It's changed. It's probably changed forever. Like, we are going to do things virtually a lot more and not face-to-face as much because we don't need to, right? So you could show me around your house right now, doing this call, and I could go, oh, okay, I see what you did, and you did the kitchen, you did your yard, and saw that. Like, I could get a pretty good idea of it.
Yeah.
Right? Better than a photograph.
Yeah.
So we're expecting there to be some pressure on inventory in the coming month or two, and then it just might. So if you were thinking about selling, if you were remotely thinking about selling, and you know that you can buy, you have an out. We have to make sure that your exit strategy has a place you can land first, right? And if all this forbearance stuff, and if you think you want to do it, now is a good time to do it. So call me, Daryl Palmer, Remax Estate Properties, at 310-502-4240, 310-502-4240, or you can go to www.meetdaryl.com, MEETDARYL, meetdaryl.com, and you can just schedule a 20-minute appointment. I had Dave do this with me, and it jumped right into an automatic Zoom because I set this thing up. It's pretty cool.
Love it.
Yeah, we like that. So one other thing that COVID, I think, has done is, like, parking on Pier Avenue and on Manhattan Beach Boulevard is super easy. That's good.
Enjoying that right now.
Right? And people seem to be nicer at 6 feet apart, I think, except for the people who are running down Beach Drive and spitting and brushing by you. Like, what the heck? You couldn't move over a foot, you idiot. I'm a runner.
Yeah.
I get it, but we get in the zone, but geez.
Yeah, they're doing wind sprints right past you, just spitting and sweating and up.
Now we can go on the beach, and we were running this morning on the sand. I will be sore tomorrow. Yeah. Okay. So we talked about demand is rising. Oh, the big thing. So here's what happens in a recession. Like, all the deal people come out and they're like, oh, we're going to go and lowball everybody and we're going to get some deals. Guess what has happened? Prices have not dropped, at least here on the Strip. On the coast, prices have not dropped. There's been a couple of things where people had to get out, and there's a new construction that's been on the market forever, overpriced. And they think they made a concession with the action, but sold it at market value. But there has not been any value drops right now. So this low supply is going to, last time when we did this, the supply was massive. And so, of course, the people couldn't sell. They had to drop the price to get a buyer when you have massive supply and very few buyers. Now we have very few buyers, but very few homes. So there has not been a drop. And if you're looking for a drop, take a look at what's actually happening, because demand is actually rising.
Well, Daryl, just to add my 2 cents on that is, I think a lot of people confuse value with price. And really, they're two separate concepts. So you might see some price adjustments to listings out there because, like you said, maybe they were completely unreasonably priced in the first place.
Oh, that never happens.
10% haircut. So it wasn't in the market.
Yeah.
That doesn't mean that your home value for your neighbor went down. It doesn't. It two totally separate concepts. So I think if people hear, oh my God, I heard that the MLS is seeing price drops and this and that, it's like, don't worry. That doesn't mean they were probably overpriced the first. They weren't right priced in the first place, right?
Right.
And even to that effect, even CoreLogic is really they've got their thumb on the pulse of the market for the entire country. They see a very small, maybe 1% drop in home value, right, this year, maybe, right? Guess what's going to happen next year? 5% plus.
Right.
So you know?
They're even saying that we might even see a 3% uptick in values
Oh,
this year.
here locally, absolutely.
Q3 and Q4. So
yeah, absolutely.
if you're in the market, get in the market, but don't wait for a drop, because you will be a year from now going, oh crap, I really missed that one. So it's
you have
just
some interesting figures talking about affordability based on interest rates. Maybe we could touch on that.
Let's take a look.
Really good point.
You want to look at this one first? This was comparing the payment prior. That's the red right here. The payment prior to the Great Recession. So that was in 2007, 13 years ago, right before we started that mess. Interest rates were 6 and 3, low sixes, and we were like, wow, low sixes, that's awesome. Right? We were thrilled that they were at 6 because they were at 7 before that.
Right, yeah.
And so you look at this payment, like you go to the top one, just take the middle one, $875 purchase price, all the way left, 20% down, $175K, 30-year fixed, 80% down, 80% loan, $700K. Payment prior to that was $4,300, and payment today at 3.25 would be $3,050. Annual savings $15,000, almost $16,000 different from what 13 years ago and now. And people are like, oh yeah, but we waited and we got a little bit off. But you compare that, you cannot compare it because the interest rates now are so ripping low and probably going lower. So here's what this looks like if you're just saying a $3,000 a month mortgage payment. At the interest rate at 5%, it's $698, all the way to the right side in the red. $698, let's call it 7. You can afford $700,000, right?
Yep.
And then at 4.5, you can add another 40. At 4%, it's $785. That's like almost $100,000, like you said, between interest rate, 1% interest rate can drop it almost about $100,000. So right now we're in this 3.5-ish range, Dave, right? 3.25, 3.5-ish, depending on the borrower. So if you want a $3,000 payment, put 20% down, this is the kind of loan you can get. So waiting is really dumb, because if you're a buyer in this market, you don't have a lot of competition. But when people start going, oh, we can go outside and go buy houses again, there will be a lot of competition, and we will see multiple offers again. Even in Torrance at 700,000, a lot of stuff under $1 million is getting 10 to 15 offers 2 weeks ago. 2 weeks ago, we were still kind of in the dark and going, but now things have opened up. Yeah. So if you're a buyer in the market, get in the market. Don't wait, because waiting will get you maybe a little bit lower interest rate, but it'll get you a higher number of people you have to compete with and a lower chance that you're going to buy a house.
Yeah, it's so true. The effect of interest rates on buying power and purchasing power is just, it can't be understated. Truly shocking. Like you said, for that $3,000 a month payment, every 1% in interest rate is the equivalent of about $100,000 in home price, right? So I think anybody trying to time the market for some kind of drop, I think they're out of their minds. They should be looking at this like right now, today, interest rates are rock bottom low. Now's the time to strike, because in all reality, what's really important is your monthly payment, really, right? Your cash flows. Right. That's the really critical numbers. So, and the fact of the matter is this, we're in Los Angeles, we're in one of the most sought after cities in the world, right? And when you look at the demographics of the, job market around us now, obviously the service industry has been pretty decimated, right? And, that's, nobody can understate that. But when you think about here in our area, I'm thinking about the aerospace and defense industry jobs in El Segundo, where the average salary is $250,000 a year. Those guys don't seem to be going anywhere, still have their jobs. When you think about Silicon Beach, right? All the tech that has come down from Silicon Valley and set up shop there, whether it's Google, YouTube, Facebook, Electronic Arts, you name it, all the big dogs that are at like record stock prices right now, right? And then continuing your way up to Santa Monica, right? Like it's just tons and tons of high paying jobs. And so those folks haven't really lost their jobs yet. And so, you know, those people are continuing to be hungry for real estate. They want to get into homes. They've got the means, they've got the capacity. And so we're just not going to see this big correction. You know, it's interesting to note that 40% of households that earn $40,000 or less are out of work right now. That's a staggering number. But guess what? They're not the ones buying the homes that we're looking at.
No.
You know what I'm saying?
No, they're not.
So anyway, I think we need to look at this, you know, collectively, holistically, how it applies to this local market here in LA, because the demand far outstrips the supply. And it really, you got to look back to birth rates. If you got, you know, the average age of even, let's kind of talk about like the first time home buyer, right? Average age of first time home buyer is 34 years old. If you were to look at a chart of birth rates going back 34 years from today, that is like the most record number of births in the country. Those people are hitting the market right now. And so you've just got this massive, you know, demand that will never be satiated by the supply here. So you're just never going to see a correction like that people are thinking of and people have in their mind from the Great Recession, which was totally unprecedented territory. And honestly, that bubble deserved to burst, and you know it did. So
yeah, it was terrible. Yeah, so we're not Barstow for, you know, not like that. What else? I think that's what we wanted to talk about. Oh, I was going to say one little stat. So in 2007, pre-Great Recession, LA County had 32,000 listings. I'm just talking about LA County, which is a very large space, as we know. And in 2020, this was just last week, so 32,000 in 2007 active listings. In 2020, last week, LA County has 10,000 active listings.
Wow.
It's like 2/3 less active listings plus.
Yeah.
And so it's a supply and demand thing. The demand is low, but supply is also low. So the demand's going to increase. The supply will increase a little bit. But as you can see in the photo behind me, if you guys are on video and not on audio, that it's very dense here. Very, very small lots. When, you know, we have our half lots are 1,100 to 1,300 square feet.
Yeah.
And our big lots are 2,700 square feet, or 2,400 if you're in Hermosa. So we're very dense here. You can't build houses underground here because of the water table. All right. Well, thank you, Dave Ramirez from Movement Mortgage. You are a rock star. And so if somebody wants to talk to you or talk to you about a loan or the forbearance thing, how do they get a hold of you?
Absolutely. Well, Daryl, thanks so much for having me. Always a pleasure, my friend. Always enjoy your insights, and I look forward to catching up with over a cold beer when we can socially distancedly appropriate do it again.
Each other.
But yeah, that being said, if anybody would like to reach out for more mortgage information, you can definitely reach out to me. My cell phone number is 970-708-1324. And you can always hit me with email at dave.ramirez, Ramirez, @movement.com.
Okay, that's good. And I'm Daryl Palmer. You can reach me at Daryl@darylpalmer.com, DARYLPALMER, Daryl@darylpalmer.com, 310-502-4240, or you can just go to www.meetdaryl.com and set up a 20-minute strategy session, and we can talk face-to-face like this and see how we can help. So if you've listened, if you've gotten this far, you understand that Dave is a rock star and he knows his stuff. So that's super important when you are getting into this bowl of soup, because you need to work with people like Dave and I who have a ton of experience. We've been there, done that, seen it. We know a lot of these things. We can keep you out of these snafus just by asking way more questions than the other dum-dums will ask. So we're the other kind of dum-dum.
We try to find the landmines before you step on.
Right? It's all about pre-framing.
Yeah.
Anyway, so thanks for joining us on It's a Beachy Thing. And you guys are the best. Thanks again, Dave. We'll see you later.
Thanks, Daryl.